Just got your first paycheck? That is a huge milestone. Congrats! But yeah, with that first taste of financial freedom comes a whole new world. Taxes. I know, it can feel a little overwhelming, but don't you worry. Over the next few minutes, we're going to break down exactly what you need to know to handle it like an absolute pro.
So you're officially a taxpayer now, and you're probably hearing all these new terms thrown around, like PAN, TDS, which is just a fancy way of saying tax deducted at source, basically tax paid up front, and of course, tax regimes. Our goal here is to just cut through all that noise and give you the simple facts you need to make smart money moves from day one. Okay, first things first. Let's talk about what is probably the single most important number in your financial life in India. The best way to think about it? It's like your financial passport. It's called your PAN.
So, what is a PAN? It stands for Permanent Account Number. It's this unique 10-character code that the Income Tax Department gives you. They use it to track all your major financial activities. We're talking your salary, your investments, the taxes you pay, the whole shebang. It's pretty much your unique ID in their system.
And get this, it's not just a random string of characters. It actually has information about you baked right in. If you look at your own PAN card, you'll probably see the fourth letter is a P for person. And the fifth letter? That's the first letter of your surname. A pretty neat little detail that makes it uniquely yours, right?
So, why all the fuss? I mean, why is this one number so incredibly critical? Well, because not having it, or even just forgetting to use it, can come with some pretty steep consequences. Let's take a look at just how steep.
Okay, listen to this. If you don't provide your PAN to your employer, they are legally required to deduct tax at a flat rate of 20%. Yep, a fifth of your paycheck, gone, before it even has a chance to hit your bank account. That's way higher than what most people actually pay.
And it doesn't stop there. If you're supposed to have a PAN and you just don't get one, you can get hit with a flat penalty of 10,000 rupees. That is a costly and honestly a very easily avoidable mistake. So the bottom line here is your PAN is your key to almost every big financial door. You can't file your taxes, you can't open a bank account, you can't make any large purchases or investments without it. It is absolutely 100% essential.
But here's the good news. Getting a PAN is actually easier than it's ever been. You can apply for an instant e-PAN online, for free, just using your Aadhaar number. It's fast, it's digital, and it's just as valid as the physical card. So there's really no excuse not to have one.
All right, so you've got your PAN. Now you're facing your first major decision as a taxpayer. It's like a fork in the road. You've got to choose between two different ways of calculating your taxes. We call them tax regimes.
So here's the fundamental trade-off, plain and simple. You've got the old regime, which has higher tax rates, but it lets you lower your taxable income by claiming deductions for things like investments, rent, insurance, all that stuff. Then you've got the new regime, which offers lower tax rates right off the bat, but you have to give up almost all of those deductions.
Let's look at how this actually plays out with the tax slabs side by side. You can see right away, in the new regime, you're paying zero tax up to 3 lakh rupees, and then the rates climb pretty gently. But look at the old regime. The tax-free limit is a bit lower, and you hit that much bigger 20% bracket a whole lot sooner. The difference can be really significant, especially for folks in the middle income bracket.
Okay, now this is probably the single most important thing for any new taxpayer to get. The new tax regime is now the default option. What does that mean? It means if you do nothing, you're automatically in this new system. To use the old regime and get all those juicy deductions, you have to actively raise your hand and opt in.
So how does this choice actually affect your take-home pay? Let's stop talking about abstract numbers and jump into a simple, real-world example.
Let's imagine your annual salary is a nice, round 10 lakh rupees. And for this scenario, let's just assume you're starting out and you don't have any major tax-deductible investments or big expenses yet. We're just looking at your straight-up salary.
Whoa, okay, look at this difference. Under the old regime, your annual tax would be about 1,17,000 rupees. But under the new regime, it drops all the way down to just over 62,000. That is a huge, huge difference. That's a saving of over 54,000 rupees a year. So for someone with no deductions, the new regime is a clear winner. It's a no-brainer. But, and this is a really big but, if you have major expenses like rent, a home loan, or you're making significant investments, then the old regime's deductions could very well still save you more money. It really, truly depends on your personal financial situation.
All right, so let's bring it all home. What's the bottom line here?
What are the key things you need to walk away with to confidently manage your taxes for the very first time?
Here is your simple 4-step action plan. First, get your PAN. It is non-negotiable. Second, really understand that trade-off between the old and new regimes. Third, actually sit down and calculate the tax for your specific situation. And finally, make your choice, always keeping in mind that the new regime is the default setting.
So ultimately, the question is this: do you prefer the simplicity and lower rates of the new regime, or are you willing to track deductions to maximize your savings with the old regime? The choice is yours, and now you've got the tools to make it wisely.